Your retirement savings are in jeopardy. The banks and Wall Street firms are looking out only for themselves. The markets are confusing and treacherous to navigate without help. The number one financial question is, am I going to run out of money in retirement? Paul Merriman is here to help.
Imagine putting your head on the pillow at night without worrying about your bills.
Paul Merriman is an educator, award-winning podcaster, and best-selling author whose straightforward advice about retirement savings and managing money has been followed by tens of thousands of people.
You have the chance to double or even triple your returns over a lifetime. And the sooner you start, the better off you are.
Learn about his 5 life-changing choices to help you grow and manage your money in financial fitness after 50.
When you follow my plan, you will have more money with less risk. And best of all, more peace of mind.
Here's Paul Merriman.
Thank you very much. Well, I'm Paul Merriman, and I spend my life talking about helping people make money, keeping people from losing money, trying to lower their risk, trying to keep them out of the hands of either thoughts or people that will do more damage than good. And boy, one of the things that can do a lot of damage are the myths of money. And what this list is about is the 20 money-losing myths. Now, what is a myth? Well, a myth is really something that's unreal or imaginary. Normally we think of a story when we think of a myth. And all myths at some point along the way were believed to be true by some people. Now, in the investment community, in the money business, the myths normally have some sort of a following, and very often those myths are perpetrated by people who make some money off of those myths. Now, let me take you through those 20 money-losing myths. One of those is that stocks are risky. I know that's easy to believe. You've seen so many articles over the last few years about how people lost money in the stock market. And yes, if you buy one at a time, if you only own Microsoft or you only own Enron, in Microsoft over the last 10, 12 years, you've probably lost half of your money. If you owned Enron, you've lost 100% of your money. Yes, one at a time, they are risky. But one at a time, it's not an investment, it's called a speculation. But how do you handle that? Well, it's real easy. You diversify. And so a lot of people think because you diversify and you have many stocks, and you have many stocks in many industries, you have many industries in many countries, all these levels of diversification, they relax and they say, I have now eliminated my risk. Well, then October 19th, 1987 comes along, and in one day, the market goes down 22.5%. Around the globe, it went down like that. So now all of a sudden, it really sounds risky because it says it's not just a matter of losing money, all your money or half your money on one stock. It could be you could lose a quarter of your money in one day. But the other side of that discussion would be, there's never been a permanent bear market. There's never been a time that the market went down and kept going down and didn't come back. It has always come back. Doesn't mean I can tell you I guarantee it will come back. I certainly can't guarantee when it will come back, but all of history says it comes back. But if you have a part of your money placed in the stock market, you have a wonderful inflation hedge. Much better in reality than gold, Because if we look back over the last, I don't care what period of time, if you want to look back over, how about 80 years, going through the Depression, going through the Second World War, going through all of the inflation, the oil crisis, all of these bad things that we've gone through over the last 80 plus years, the stock market has made, I'm talking about a very broadly diversified portfolio, has made about 10% versus about 3.6% for the no-risk government T-bills. Now you apply the inflation to that, not even taxes, but inflation, and the stocks come down to about 7, while the T-bills make less than 1%. So stocks have been a phenomenal hedge against inflation. And if you're taking money out of your portfolio in retirement, if you have even, let's say, 20% of your portfolio in the stock market as a part of your whole mix, 80% bonds, 20% stocks, over time the returns are 5 times with that 20% in stocks compared to not having any stocks at all. So you can say that stocks are risky. You can believe that. But if you're looking at the long term, if you're looking at great diversification, then the risk, at least historically, it seems to kind of disappear, and it actually becomes a bonus rather than a penalty to own stocks. And now we have to have the number 2, myth number 2. You can beat the market. Yes, you can say that. You can think you can beat the market. It's actually possible you could win the lottery too. And there's no wonder that you believe you can beat the market, because Wall Street sells performance. Wall Street's always saying, we have the best analysts. We know how to do better than others. We have the mutual funds that have 5 stars. By the way, that means they're the best. Of course, what we happen to know is those star funds don't necessarily turn out so well, but it doesn't mean that that would keep people on Wall Street from finding ways to claim that they know how to beat the market. And Wall Street kind of likes to sell to the path of least resistance. They like to sell what's been doing the best lately. And when you see what's been doing the best lately and they recommend it, it's just human nature to respond by saying, well, now that's a good idea. That's where I wish I had my money and made that money. I think I'll take some of that. But then what you take oftentimes is a beating, because you're getting in after that's already had that big run. And one of the challenges, knowing what is the market. When somebody says, I can beat the market, well, that could be a very selective way of reporting your performance. For example, if you said, my fund can beat the S&P 500. Well, the S&P 500 is basically a growth portfolio. And so if what you're saying is, I can beat the S&P 500, but you're a value portfolio, guess what? That doesn't have anything with you being smart. Value beats growth. If you had small companies in your portfolio, small companies beat large growth companies. So you can pound your chest and say you're the best, I beat the market. But what you did was you simply had a different market. So we as investors need to be careful that we're not misled into thinking that this ability to beat the market is real. In fact, the evidence of people's ability to beat the market, it's not very encouraging. In fact, it's downright discouraging. Morningstar reports, and has reported for many years, on mutual fund performance. It's a great resource on the internet, morningstar.com. And you'll see on the page about each of those mutual funds some stars. 1, 2, 3, 4, 5. 5 is the best. 5 is the top 10%. And then 4, that's the next 22.5%. And it finally gets all the way down to 1, and that's the worst. That's the bottom 10%. And what so often happens is that a manager, Legg Mason Value Trust, Bill Mason, the manager, Bill Mason beat the S&P 500 for, I think, 15 years. And people just kept writing checks. Whoa, this man has found a secret. He has found financial nirvana. Just bet on Bill. And for the next decade, when people were betting on Bill like mad, he fell from the top 1% to the bottom 1%. And so it is very difficult. And some will. But what we don't know is really whether it's luck or skill. The academics say, some academics say, it takes 70 years of performance to be able to really tell statistically whether the person was smart or lucky. Well, where are you going to get 70 years of performance? But what we do know, and this is the neat information, I think, is that a diversified portfolio, a portfolio that has some large and small, some value, some growth, some U.S., some international, has outperformed the S&P 500 by 2 to 3% a year over the last 40-some years. Now, does that mean it beat the market? No, it's simply a different market. And that's the choice you have. You have the choice to design what you call the market. And my hope is that you will design your portfolio to be the market that has historically paid the highest returns without taking more risk. And when you think that I want to beat the market, and there's this like almost a male thing, the hunter, I'm going to beat the market. Understand that when that market is down 50% and you're down 40, way to go, you beat it. But is that really what you wanted? Or is what you really wanted to get the highest return you could within your risk of loss limits? 40% might have been way beyond what you were expecting, but by golly, you could tell your friends at the club, I beat the market. And here's the part that gives me great hope. You don't even need to beat the market. If investors could simply get the market returns, it is historically a phenomenal return. But again, we want you to identify what that great market is. Number 3, index funds produce average returns. Now you think about an index fund. That actually seems to make sense because the index fund is the return of all, let's say all the large companies, all the small companies, all the value, whatever you get, you own them all. Yes, you're going to get the average. And so the people who sell mutual funds, they'll look at you in the eye and say, Joe, do you want to be average? Oh, no, I don't want to be average. I want to be better than average. Well, you wouldn't want to be in an index fund because you'll just be average. Guaranteed, you'll be average. But what is average? John Bogle did a study from 1980 to 2005. And in that study, he looked at the return of all U.S. equity mutual funds. 10%, that's a good return. But during that same period, the S&P 500 compounded at 12.5%, underperformed on average by 2.5%. So what's the average? Sounds to me like the average is the 10%. And somehow the 12.5% that's average is better than average. It's tricky. And to make it more interesting, remember that the S&P 500, it's the best quality of the indexes. Lots of indexes did a lot better than that, which even puts the 10% to greater shame. So indexes beat indexes. And indexes beat indexes because small cap would be better than large. Value better than growth. So don't be suckered in by this idea that index funds only give average returns. Number 4, bonds are better than bond funds. Now, why would somebody say that? Well, one reason that they'll say bonds are better than bond funds is because when you buy a bond, it has a specific maturity. So if you buy it and it's going to mature in 5 years, you get the interest for 5 years, whatever that interest is, doesn't go up, doesn't go down, it's the same for 5 or 10 years, and then they give you your original investment back. Now that sounds like a pretty good deal. But when you have a bond fund, and in a bond fund you might have 200 different bonds, you have diversification. You have protection from one of those companies who said, I promise to pay. When they don't pay, then you in fact have other bonds to protect you, diversification. And the beauty also of the bond fund. Remember I said that you put that money in there on day one, let's say it's a 10-year maturity, promises to pay 5%, and it pays 5%, gives you on that $1,000 bond $50 a year for 10 years. But what happens if interest rates go up? Well, I'm sorry, I know, yes, interest rates are now 10%, but remember, I promised to pay you 5%. I'm not paying you anymore. But in a bond fund, as new money comes into the bond fund and the interest rates go up, then they buy higher interest rate bonds, and all of a sudden, you're getting more and more interest in that bond fund. Now, the bond buyer, the individual bond buyer is going to say, yes, but if interest rates go up, then the bond can go down. The value of the bond can go down. That's true, which is one of the reasons that the academics tell us to have bond funds that have relatively short maturities. Don't buy bonds that mature or bond funds that hold long maturities. And the other thing about bond funds is you have one-day liquidity. One-day liquidity without arguing about what the price is. One-day liquidity, whether you want to take out $100 or $5,000, or you want to sell a little bit or all, you still can have liquidity in one day. And if you're a small investor and you don't have a lot to put in, you can put in $50 a month because you're going into a fund. You don't have to put up $1,000. And every time that bond fund pays an interest check, a dividend check, it can automatically be reinvested. It goes right back to work. As opposed to a bond, they send you a check, some interest, and where does that interest go? Well, I'm not sure. It's only $50, and well, maybe I'll spend it. So the bond fund tends to be a much more efficient, more liquid, and under most conditions actually works better than the individual bonds. All right, let's look at number 5. Great companies make great investments. Isn't that what we were taught? I remember when I first came into the industry in the mid-60s, the idea was back then, we didn't have all of the electronic technology that we have today. But they would say, now just buy shares of companies, great companies, and just put them in a safety deposit box. You actually got the certificate in those days. Just put them away and hold them. You don't have to trade them. Just buy good companies. And they will pay you not only dividends, but they'll grow and grow and grow. And the most popular companies when I went into the business were Sears, AT&T, and IBM. And it turned out, and by the way, in the early 70s, there was this thing called the Nifty 50. It was kind of like owning Sears, IBM, and AT&T, except these were the 50 best companies for the future. Great companies. But the history of great companies, interestingly enough, is that they don't pay huge returns. Once people figure out that a company is a great company, they've already bid the price of that company up. So the people who come in to put their money aside for the long term end up coming a little late to the party. And so that nifty 50 turned out over the next 30 years to do about half the return of the S&P 500. And then, if you look at what people claimed were great companies, I know this is going to sound strange, but a book called Creative Destruction that was written before the Enron collapse and before the collapse of Corning, they said in that book they could find three companies that were companies that had held up over the years and not become just kind of has-beens. Three companies that continued to grow and be on the cutting edge. One was Johnson & Johnson, done okay. The other two were Enron and Corning. When the book came out, Corning was about $100 a share. You might have made a mistake. Or you slowly move into those things that you think might be good for you. Which brings me to number 16. And that is that dollar cost averaging is a safe way to invest. Well, yes, dollar cost averaging is a smart way to invest because it forces you to buy more shares when the market's down, fewer shares when the market's up. That's the good news. And I'll have people who will come to us with a big rollover, a 401k or an IRA or something, but they're rolling it over and they want to put it to work. But I don't think I should go in the market right now. I think maybe going in the market right now is pretty risky. It's always risky. There's never been a moment in stock market history that it hasn't been risky. In fact, the tough part is that the better things are, the more risky it is. And the worse things are, the least or less risky it tends to be. So what they do is they arm wrestle with themselves. How can again? Well, what if I dollar cost average in? What if I take this pool of money and put it in slowly, maybe over a year or two? I break it up into 12 equal payments and dollar cost average in. Would that be a safer way to go? They'll ask me. And I'll say, yeah, emotionally, yes, it will be safer. But understand, you never get away from the risk. So you go in and you start dollar cost averaging in, and while you're dollar cost averaging in, the market's going up, and finally at the end of 12 months, you're in. Whew! That was not easy, but I'm in. And then the market goes down. You never get away from the risk of the market going down, with or without dollar cost averaging. Number 17, load funds are okay as long as you get a good return. You know, buying lottery tickets are okay as long as you get a good return. Anything that you can know will work out. You see, there's no risk in the past. Somebody will say, well, here's a load fund that did well. Not all load funds did well, but this one did well. And I'll say, well, how can you tell me that this one's going to do well in the future and that it'll be worth that load? Well, I can't say that, but it's done well. They'll say, yeah, it's done well. But all the evidence is that there's no way to tell which ones will do well. The things we know is if the expenses are low, the diversification is high, and they're in an asset class, a kind of stock that does well, you do well. And there's no reason to pay a load to get into that. So I think that idea that, well, you can pay as much as you want as long as you do well, that is an absolute myth. The load has nothing to do with the management of the mutual fund. Zero. And I've even heard, let me give you this one you won't believe. I got to throw it in for you about the loads. I was trying to, in fact, I promised my wife that I wouldn't work for a week, which is very difficult. And we were back on the East Coast, and she wanted to visit a Lord & Taylor store. I said, great, as long as I can make a phone call. So I made my phone call because I had this email from this young lady who had $43,000 and she was befuddled about what to do, and some broker was trying to get her to go into a load fund. And I couldn't help myself. I picked up the phone and I called her. And what she was told by the salesman is that no load funds don't do as well as load funds because the people who run load funds are smarter. The people who run load funds go to better schools. God, Lord. I couldn't believe it. This guy would say anything to try to convince this young lady that she was better off in a load fund than a no load fund. It's funny, but it's sad. Number 18. I would have been better in CDs the last 10 years. I wonder how many investors heard that from a disgruntled spouse who may not have wanted to take the risk in the first place. Yes, compared to Microsoft, compared to GE, compared to hundreds, if not thousands of stocks, CDs did better than the market for 10 years. CDs made about 2.6%, while companies like Microsoft down about 50%. But if you compared the return of a portfolio that was balanced between some stocks and some bonds, it turns out that that kind of a portfolio did better than 6% over that period. If you were overweighted to technology, you were in trouble. But here's the reality of what happens to our money. We know the right thing to do in the past. There is no risk in the past. We should not have been in Microsoft. We know that now over the last decade. GE, a company that could be trusted forever. Well, maybe not every year, trusted forever. So is it true that CDs did better than stocks over the last year? Well, sometimes they do. When somebody says that, they're right. We know that about 1 out of 3 years, CDs do better than stocks. That's not a surprise. In fact, there'll be periods when 1 or 2, maybe even 3 years in a row that CDs do better than stocks. But we're not worried, or we shouldn't be worried about 1 year at a time. Over time, if we look at the returns after inflation, after taxes, the returns can be 4 to 8 times with stocks over CDs and also many of the bonds. So I think you got to be careful when somebody's telling you, yeah, we would have been better if we kept our money in CDs. It's always easy to know that afterwards. But for the long term, that can be a huge mistake. Number 19. You should only invest in businesses that you understand. This was part of one of Peter Lynch's books. If you want to invest your money, put it somewhere you understand. Even go look at local businesses in a mall to get an idea of what looks good. Very dangerous, very dangerous. A friend of mine did that with banking stocks. He thought banking stocks were the place to be. Had almost all of his money in banking stocks, and of course, when those stocks hit the skids, he had to extend his retirement. I mean, he had to keep working probably an extra 5 years because of that. And if you only invest in companies that you understand and that you know, you're going to end up in a portfolio that probably doesn't have many small companies, doesn't have REITs, doesn't have much value, probably doesn't have any international. You probably end up owning mostly local companies. But what do you really know about those companies? Really? Do you know their books, all the things about their accounting and their business that you should to put a lot of money in those local companies? See, I think it's easier to understand the concept of small companies or small cap companies. I understand owning all value. I even understand owning all emerging market stocks. I don't understand the individual companies. I don't have an inkling of what they're doing. But when there are 3,000 of them in the emerging market fund, I don't have to worry about the individual companies, but I understand that class of stocks. That's something you could understand. Number 20, everybody should have 6 months of emergency money sitting in a money market fund. Well, maybe it's not fair to call this a complete myth. It's not really wrong. But to begin with, emergencies don't happen all that often. And when they do, the amount that you need can be relatively small. But if you're making $60,000 a year, you don't have to have $30,000 in order to have 6 months worth of income, because when you aren't working, if that's the emergency that you have, it does not take $30,000 to replace the $30,000 you would have made if you were working, because if you were working, you would have had to pay taxes. You would have taken some money out to put into a 401k plan. There would be, in fact, you'd probably do a fair amount of traveling when you're working, but once you lose your job and you don't have that income, you're not going to spend that money on travel. I actually think that what happens when you work hard to put away that emergency money when you're young, that you are passing up an opportunity in those early years of employment of stashing away some money into a 401k and the company matching it. And so if you really want to have some sort of an emergency fund, what about taking those early dollars and instead of building an emergency fund, put that into a 401k, but keep part of it in bonds. Keep yourself liquid so that you would have access, low-risk access to some of that money. Might cost you a little penalty or not, depends. You may just borrow it out of that 401k. But you would have access to it, and you wouldn't have to lose that leverage of being able to get in there and have access to that 401k plan. And if I can throw in just one quick bonus, very quick, watch out for the advertisements for 4- and 5-star funds. Yeah, they made more money, but there is no evidence that they will do better than other funds in the future. In fact, the studies show that the expected returns of funds that achieve the highest status is actually lower than average in the future. Another myth, money-losing myth that I think costs investors a ton of money. And I hope my exposing these myths to you will make you a smarter investor, help you make more money, help you take less risk, and give you peace of mind that you're doing the best you can to prepare for the future. Thank you. Thank you very much. Thank you.